At 6 Meridian, we are committed to exceptional client service and evolving to meet our clients' ever-changing needs in the ever-changing landscape of wealth advisory. That landscape recently changed significantly in the form of the U.S. tax code. In this 4-part series with Mitch Caddell, CPA of BKD Advisors, we will explore those changes and their possible impact on you as you plan for 2018 and beyond. We hope you find this series helpful and informational as you navigate the sometimes complicated world of tax planning. Mitch, as our clients review their estate plans, are there any changes of which they should be aware?
Well, there's a few for this coming year. The first thing that I would mention that really affects everybody is the overall gift exemption. In the past, you've had $14,000 you can gift without having to tap into your unified credit. This year, that limit goes up to $15,000. So that's one thing that I think anybody who's gifting, they can give a little bit more this year and not have to necessarily tap their unified credit. And then probably the biggest thing that came out of the whole estate part of the tax bill this year was the overall limit for what you can give over a lifetime went from about 5.6 million up to 11.2. And so I think what we're going to end up seeing is something similar to what we did in probably 2009 to 2011 when we had the 5 million limit come into play to start with, and people were planning their estates to try to maximize that amount. And we're afraid that Congress after 2011 might go back to a lower amount. Of course, in 2025, we're back in that same boat we were in about 2011 of, well, is this going to go backwards? Is it going to stay as it is? Is it going to continue the inflation index? What do we do? And so I think to answer that question, clients are smart to go ahead and start thinking about between now and 2025 what they can do to maximize that amount, just to ensure that their estates are not going to be taxable, or at least you're going to minimize the tax once you get to the point in time of death. With regards to the rates stayed the same at a top rate of 40%, so there's not really any change in that regard. And GST is still around, so there's nothing really different there either, other than we do have the $11.2 million exclusion for GST, just like we do with regular estate tax. So that's basically kind of where things fell out this year, but great opportunities to start thinking about maybe doing some new trusts or some other estate planning.
Mitch, a number of our clients, both parents and grandparents, use 529 plans to plan for their children or grandchildren's education. Can you talk about any changes that came out of the new tax plan related to that?
529 plans have always been catered just to college expenses in the past. And so, people put away for a number of years and saved for their various students' expenditures that are going to be coming up, for tuition and books and room and board and all the things that go along with college, because it is a huge expense. Well, what has happened this year is Congress decided that they wanted to give kids more opportunity for different types of education. And so they've now opened up so that with a 529 plan, you can pay K through 12 expenditures, whether it be for a public school, a private school, or a religious school. So it really gives parents the opportunities to send their kids to whatever school they want, gives them a unique funding opportunity that allows them to potentially tax defer earnings and put money away to pay for these expenditures, and gives families just a lot more options relative to education.
Now, Mitch, there was a change that affects a number of our clients in terms of them being sports fans, and that is the deductibility of your payment for sports seats. Can you please elaborate?
There is a change to the deduction, and what happened was typically when you get your bill from the university, you've got a charge for your seat, and then you have a charge to typically some kind of university charitable fund. And what's been allowable in the past is that contribution to the charitable fund has been allowed at 80%. And so folks have been able to deduct that particular piece as a charitable contribution. Well, beginning in 2018, unfortunately, that 80% deduction that they've gotten in the past is going away. So you're still going to have to pay your same amount for your seats and probably make your contribution in order to have your priority seating, but you're just not going to get that charitable deduction that you got last year.
Mitch, is there any change to the limits on charitable deductions?
Most public charities, including churches, public charities, and various other exempt organizations, typically have had a limitation for gifts of 50% of your AGI on your itemized deduction for charitable deductions. And so, when you're looking at a taxpayer, let's say they've got $500,000 of income, they're limited to up to $250,000 of income if they contribute to these types of charities. For 2018, that number has now gone to 60%. So it gives taxpayers an opportunity to give yet a little bit more to these folks and to take advantage of some additional deduction. And given the fact that some of the other deductions have gone away, it might give them a new area that they can start expanding to help bring down their overall tax liability.
We've highlighted major changes that have come about due to the new tax law. Every situation is different, so we recommend that you speak to your tax professional as you're planning your tax situation going forward. Thank you for joining us.